Okay. Hello, everyone. My name is Harry from MoneyOwl. So Trump tariffs and trade wars. You cannot be serious. Right? The slew of tariffs announced by Donald Trump last night has shocked the world, has stirred up turmoil in the financial markets. Some have called this a once-in-a-century event. Right? But how does this change our investment playbook? Right here with me is Ting, CEO and Chief Investment Officer of MoneyOwl, and she'll tell us a bit more about what all this means for you and me. I'll pass the time to her, and I'll be back later to ask her a few questions.
Thanks, Harry. So, indeed, a once in a century event. I always say that in my job at MoneyOwl, my chief investment officer job gives me no trouble. And is that still the case last night? Before I start, just a quick reminder that these slides and what I'm going to say are just for reference and informational purposes. It doesn't take into account your specific investment or financial planning objectives. So this happened. It was quite surreal to see in Rose Garden the President Trump with his, I think he called it a board of terrorists, on which Singapore also appeared, despite us having despite US having a trade surplus with us. And of course, the markets absolutely tanked. I had a lot of people coming to me saying, oh, it crashed. Luckily, I didn't buy, and so on. There's a lot of fear. On the economic side, DPM Gan had come out to warn of rough waters and to say that this will have an impact, a significant impact on Singapore. So what does this actually mean? What do tariffs mean for the global economy? Is it worse than anything else that we have encountered? What does it mean for you and me in our retirement plan, our financial plan, and as investors, and in our ordinary lives in Singapore, day to day, what do we have to do? So a tariff war is indeed what we have greatly feared. There is a history to this. SM Lee Hsien Loong actually talked about this, that in the 90s, there was the Smoot-Hawley Tariff Act, which ignited a global trade war and worsened the Great Depression. This went down in the US Senate website as saying it's one of the most catastrophic acts in congressional history. A tariff war, how does a tariff war come about? Economically speaking, everyone knows that if somebody imposes tariff on you, you shouldn't reciprocate or retaliate because it makes everything worse. But politically speaking, that's not viable. So as a result, what we will see is that different countries will also start imposing tariffs on US, and the whole thing goes into quite a bad spiral. This was what happened in the 30s. So it is politics that drives this, and there are many implications, including the role of the US in the world, in Asia. How does this all pan out? And these are all the uncertainties that we have to deal with. So we look at the reaction of markets last night, and I want to say that markets are a leading indicator of the economy. So we are looking to the markets for what it thinks the economy is going to do. And here we have the US government treasuries curve, a little bit technical here, but if you look at the curve as of last night, which is the dashed line, the dashed line was what it was 1 month ago, and then you move it all the way down to the bottom line, the solid green line, and you see that it has moved down. What this means is that bond yields in general, the whole treasuries curve in general, have moved down. The yields have dropped. In other words, the prices have gone up. So more people are fleeing to safety. Investors are saying that the growth prospects are very dim. And the threshold for the 10-year bond yield, there's a psychological threshold of 4%, and it fell below 4% briefly last night and definitely this morning in today's trading. So the bond markets, which are very responsive, are telling us that the economic prospects are poor. In Singapore, we also see the 10-year bond yield go down to below 2.5%, and some of the drops are just in the last few days. Oil is often an indicator of how people think that demand would be, including for shipping and also general demand and economic activity, and that has also gone down. Actually, it's something that has been happening for a while from the economic indicators, and this is something called the Purchasing Managers Index, or PMI. And in the manufacturing space, we look at certain aspects of a survey that is conducted amongst people who purchase things for companies. And this usually tells us something. And when it drops below 50, it means that there is a high possibility that there'll be contraction in economic activities. And the new orders sub-index is one of those that I always look at. And what we're seeing is that it has fallen to below 50. And will this trend continue for new orders? That means that we are not actually seeing businesses wanting to place new orders for manufacturing, and the tariffs are not going to help. Even on the Purchasing Managers Index for the services side, now we know that the US has a lot of services in its economy, and the general index on the left, top right, whether they intend to employ people, bottom left again, new orders and overall business activity. These have also been weakening, although not yet below the 50 line. The next things to watch, in fact, later Friday tonight, will be the unemployment or employment situation. Non-farm payrolls are often a good indicator of where employers are thinking about whether they can have more manpower or not. It has been quite healthy so far. So when will it flow through to the employment market is something to watch. Overall, the tariffs are bad because they hit the consumer in a way that perhaps other things don't. The US economy consists of 70% consumption. This is quite unlike Singapore. So in other words, when the consumer is weak, the US economy in general will be weak. How does it affect the consumer? Well, firstly, directly, we understand prices will go up if things that retaliatory tariffs, prices of goods from that imported into US will go up, and that hits the consumer. A currency effect, you see the chart there of the dollar index, the DXY index. The US dollar has weakened overnight as a result of this action. So this means that the US consumer can buy less of imported goods. There's also a wealth effect in the US where stock prices go down. It tends to affect consumption as people feel not so rich, especially retirees who are living off the investments. And of course, unemployment. As businesses struggle, employment, which we need to watch, may go down. And all this can have a vicious cycle, and you actually need a policy intervention or reversal in order to manage that. Now, what is the thesis behind tariffs? Just as in the 1930s, it is about bringing jobs and manufacturing back to the US. Will it work? It remains to be seen. But even if it works, it's going to take at least a couple of years. Just imagine that Nike making all the shoes in Vietnam. Or even if they say, okay, fine, I'm going to bring all this activity back into the US somehow, how long will it take? It does take some time. It's not 10 years, but people said that at least 1+ years or 2 years. So we really have to belt in for the ride. So the economic outlook is not looking very good. That's what the markets are telling us. That's what the surveys are telling us. And unfortunately, everyone loses in a tariff war. Perhaps the US loses the most, ironically speaking. And how does this impact come about? Through businesses and consumers as they face higher costs and restrictions. And what I've described, trade. Trade is a very big thing in global economic wealth, and it's estimated that during the previous set of tariffs in that tariff war in the 30s, trade actually went down by more than 60%. The overall economic growth outlook has weakened to heightened risk of recession being the base case. Now, Singapore has said that we need to revise our GDP forecast downwards. It's 1 to 3% currently for 2025. MTI will be revising this downwards, as DPM Gan has said. There is, of course, a risk of stagflation because you're talking about potential higher prices and the lower growth, often the double whammy that most of us are quite scared of. What about policy turnarounds? In the last few months, President Trump has made different pronouncements, so much so that yesterday's 2nd of April's announcement came as a bit of a shock to some people. Well, I would say that perhaps investors will react one way. Investors might have a bit of a relief rally if some things happen and say, okay, let's scale back, let's talk, let's negotiate. Businesses in street might be a bit more cautious because unfortunately it creates so much uncertainty if there is flip-flopping on this policy. But for investors, let's turn to us as investors rather than as macroeconomists. It's a one-in-a-century event, 1930s to now. But this is not the first once-in-a-century event that we've encountered in recent times. The global financial crisis, termed the Great Recession, is from 2008 to 2009. At that time, it was regarded as really like it was going to be the end of the world, I remember one big hedge fund said there's an 80% chance of a depression. So at that point, I was thinking, wow, we should buy gold and canned food, and then just lock down. But we know that life has moved on, and here we are in 2025. And of course, COVID 2019, 2021, again, it was once in a century since the Spanish flu. So what do we know about once in a century events? Well, perhaps before that, is it going to get worse? Just as, when COVID first hit, did it get worse? Yes, it got worse before it got better. The 2008 crisis, I think it was probably late 2007 when the housing market in the US started to go down. It also got worse before it got better. And here is a table that shows earnings expectations. Now, the unfortunate thing is that in the S&P 500, analysts' earnings expectations based off the guidance from companies have actually been quite high. So these are the earning expectations or forecasts for 2025 and 2026, and it implies the stock market going to certain higher points. The price earning ratios, which is the multiples that you're willing to pay for the earnings, has also been relatively high relative to history. But of course, this was accepted for the longest time because we had a great momentum in the markets, especially among the tech stocks. And there's all this talk about US exceptionalism, the companies like Nvidia and others that would tear apart. But these are now likely to be revised sharply downwards. And if you do the math, which I won't do here, but you do the math, you're seeing that these will be below the levels. You're expected to be below the levels. Once you bring down the earnings expectations, you multiply it out, these will be below today's levels, perhaps by even quite a bit. So it might get worse before it gets better because earnings will take a hit. But this is, of course, not the first time that we are dealing with what you might call a bear market. A bear market is where you have declines of more than 20%. The once in a century event has happened before in the tariffs, and that was 1929, 1934. To be clear, the tariffs are not known to have caused the Great Depression, but it might have worsened them until they were reversed somewhat. If you look at the history of the markets, we have had many downturns. There's about 16 bear markets, I think, if you count. And how long do these downturns last? It's actually not so clear. You see that there's got 27 months on the 1932 side. Then there's some like 3 months or 6 months or 9 months. There is no pattern. You can't go back and say that, the last time this happened, that it took so long or so short. So we can't reliably predict when it might turn around. But I suppose what you can see is that there's more blue than red. There are more ups than downs in terms of the long periods. And in a bear market, we need to know how do we invest, and if we are indeed in a bear market, are we going there? So it's not something that is so new to us. So it's once in a century, of course, but so were many things until they passed. So what is our recommendation for investors? The job of your risk profiling for what you should invest in, how much equities, how much bonds, should have been done before you entered the market in a volatile time. And if you're already invested and you have a plan, we encourage you to stay put. And what is the case of staying put through these events? Well, firstly, history is on our side in terms of the evidence, and I'll show that to you a bit more. There's a logic to markets. Why is it that markets always recover and go up in the long run? There's some comfort from policy. And fourthly, to some extent, the alternatives to staying put, that means not staying put, actually not good. They can bring you more risk and more losses. And some of the things that we try to do instead of just staying put, for example, forecasting, are actually quite useless. So let me go through this quickly. Firstly, let's look at the evidence that the ability of markets to weather crises and terrible events, it's really very high. Markets have this wherewithal. They always recover and go up in the long run. So I won't go through all the things here that happened for the last 50 years, but that has indeed been so that markets have rewarded discipline. So look beyond the headlines of today. After all, this is the best wealth-making machine, especially the stock market, over the long term, and they reward investors with above inflation returns. We are very concerned about inflation, but over the long term, that has been a good thing to stay invested. But what about stagflation? Stagflation is something that we fear because it is an interesting case where you have both low growth and high prices. It's a double whammy. Again, there is some good news that the economy is really not the market. The markets actually do generally quite well even in as negative scenario as stagflation. And after markets decline greatly, they actually also bounce back to give you quite positive returns. So I hope that this is data. This is really what it is, and you can feel that comforted by this data as the evidence of why over the long run the markets have been doing well. This is over the long run, you know. I start investing at certain times. What if I am so unfortunate or have such bad luck that I enter during a bad year? And perhaps this is one of those bad years. Here is where I'd like to show you some pictures about the S&P 500. We use S&P 500 because it has a very long history of almost 100 years. And this chart will show you what has been happening. This is how you read this chart. This chart, each of them is actually comprises many, many small boxes and is put together to form a triangle or a matrix. And this is how you read it. Now, there's each box represents the annualized return, not the total return, but the annualized return. That means the per year compounded return from the beginning of the year at the top of the column to the end of the year of that row. So for example, we circled the 43.6% box. And what this means is that if you had invested into the S&P 500 at the beginning of 1928, and at the end of 1928, you will have had a 1-year return of 43.6%, a very handsome return. Now, what happens if you into the second year? Now, the second year, your annualized return dropped to 14.7%. Again, this is annualized. That means that you have to multiply it out or compound it one time over. And what happened then? Why did it drop so much? It's because of the start of the Great Depression. Now, by the fourth year, you have lost all your gains and almost half your capital. And this is what happened in the Great Depression, that 1 century ago event. Let's come a little bit closer to the other once in a century, or you can call it twice in a century event of the global financial crisis. So if you had started investing in the stock market in 2008, at the beginning of that, at the end of that year, you would have lost 37%. But by the end of the second year, your loss would have narrowed on a total return basis to negative 20 or 10.7% compounded for 2 years. Third year, further narrowing of losses to a total of negative 8.5 or compounded is negative 2.9%, 3 times over. And by the fifth year, you're back in positive territory already. So let's zoom out to the triangle. So we've color-coded this chart where the returns were positive, the annualized returns were positive. It's colored green, and where it is negative is colored red or pink. The darker the color, the more positive or the more negative. And if I was speaking to you in person, the first thing I ask you is, what do you notice about the chart? The first thing that comes to mind, in terms of the color dominance. And actually, we see that it is almost totally green. It's mostly green. And this means that most of the time, most investors are making money. And I hope that gives you some comfort about the way of investing in the history of markets. The second thing is that if you see that we do have the reds and pinks, but where are the reds and pinks? The reds and pinks tend to be along the diagonal or the hypotenuse of the triangle. Says that the deeper reds are there, and this means that the fiercest declines tend to be very short-lived because they are just along the edges. And the thing is this: let's choose the one that when you see the longest string of reds and pinks, and then you draw a line, a parallel line, and count the number of boxes until there's no more red or pink. And that is when you discover that it takes 15 years, and that was during the Great Depression, to reach green. So this means that in the last century, even if you had been experiencing the worst event, and that was the Great Depression, plus the tariffs, the once in a century event, then if you have a 15-year time horizon, you would have reached the safe zone and not have had a negative return. So this is not to say that 15 is a magic number, that it won't happen, that the world cannot crash and all that, but I hope that it gives us some perspective on this, about the history of markets and the empirical evidence about markets. So in other words, if you're investing for retirement and you have 15 years, please don't go and disturb. Please don't let this once in a century event or maybe which may not have yet played out disturb your long-term plan. Now, if you exclude the Great Depression, and there's a good reason why we might want to think about not looking at the Great Depression as a reference, and that's to do with policy, which I talk about, is actually 10 years to have reached the safe zone. So what does this mean when markets are down? It really means that we should stick to the asset allocation that we have. And this, how do you do your asset allocation? How much equities should you have? Now, Charlie Munger, the late Charlie Munger, who was Warren Buffett's partner, said that if you invest in markets, you must be able to look at a 50% decline with some degree of not be two-faced by it. It's not easy. It's like being on that roller coaster in Universal Studios. I think they call it Battlestar Galactica. And this is why asset allocation comes into play, because not all of us can ride that roller coaster. The difference between the roller coaster in Sentosa in Universal Studios and the stock market roller coaster is this. The stock market roller coaster doesn't really belt you in, and it gives you a stop button that you can press, which will cause you to fall to your death because you are defying the centrifugal force. And so that's why we want to make sure that you are in the right asset allocation. And this work should have been done beforehand. And if you are indeed able to, you have assessed that you are able to take it by your need to take risks, your ability to take risks, and your willingness to take risks, you stay put. The most important in this is actually your ability to take risks, objectively speaking. So if nothing has changed, your time horizon is still 15 years, 20 years, 25 years, 30 years to retirement or to whatever that it is, don't press that button in the roller coaster. So market conditions do not determine your asset allocation. Now, only if something has changed, especially your time horizon has changed. For example, you need the money now, you have to retire earlier than you thought, then you can take some steps. Otherwise, please stay put and don't turn that paper decline into a permanent loss. So what is the time horizon versus the asset allocation that you might want to consider? So we have this on our Invest website as well, and we see that we mix stocks and bonds. There's been a lot of talk that bonds are no longer relevant and so on. That's because bonds had come into a very bad situation in 2022 2023 because they came up from low interest rate environment, and as you know, bond prices fall when interest rate rise. But from the recent events, including the bond charts that I showed you just now, you realize that the depth of bonds is still very is overrated. Bonds still help to cushion a portfolio's return. And so this is our very conservative version, and you can explain now why there's 15 years, right? Because we are very conservative to say that, okay, even if you are so unlucky, if you have 15 years and above, the likelihood that you can take an full equity portfolio is very high. Okay. Some time ago, there was quite a bit of interest in CPF ordinary account investing. I was asked a few times in Chinese papers and also in radio. So I think what has happened in the markets in yesterday and the last month or so has really shown us that it is not the headline return of what equities can give you that is the only parameter when you decide whether or not you take out your CPF ordinary account funds to invest. So it's the same issue. Time horizon is almost everything when it comes to dealing with volatility. So I'm not saying that nobody should invest even the cash or the CPF ordinary account, but what it has shown you that is that if you could not take yesterday's movement because you need that housing down payment soon, you need that retirement funds, then you should not have been investing your CPF ordinary account. So please have the correct time horizon. Here we say we have at least 8 years if you want to invest in a balanced fund. So we talk about the evidence and from history, but what is the logic behind this? Why do stock markets always go up in the long run? Stock markets and even bond markets. Now, stocks and bonds are quite different from certain other type of assets like crypto, if you consider an asset class. They are backed by real economic return and real economic need. When you buy stocks, you're actually buying an ownership share of a company. This is a company that has response to real demand, be it in technology, be it in commodities, be it McDonald's, be it the pharmaceuticals and so on. Because of this need for capital, they issue stocks or issue equities, and you get the upside of it over time. Similarly, bonds is for financing for real companies or countries. And over time, human enterprise finds a way, no matter what happens, as long as there is demand and that quest for better living, companies will get through. Maybe not exactly the same companies. There will be a rotation amongst companies. During COVID, yes, you saw many airlines were down, but you had your Netflixes and your McDonald's and so on. Recently, we had tech go there, and we're not sure what it would be, or even which country or which sectors will be. But over the long run, human enterprise finds a way. As long as we are living in a predominantly market economy, that is the logic. Just now I mentioned that we may not want to scare ourselves by looking at the Great Depression, even though we know that is how serious tariff war can be. And I take some comfort from the action of central banks in the post-war era. During the Great Depression, one of the issues then was that the central banks refrained from getting involved, and so there were a lot of things that were left to be, and this caused quite a bit of deleveraging. Now, in the global financial crisis, at the time was Governor Ben Bernanke. Having studied the Great Depression, he basically opened up all the channels to pump money into the economy. And also on the fiscal side, asset purchases of all kinds, the markets are supported. Asset purchases through liquidity and through, of course, reducing interest rates significantly. With this action, when COVID came around, I was also quite confident that governments and central banks would be able to step up. In fact, there's this article you can still find on our website, and I said, 12% down in a week. Is it sale time or is it sell time? And I'm not saying that it's always that way that we called it, right? But it gives us comfort, right? That this, besides the long-term evidence of the markets, that perhaps that distance to recovery would be shorter, and part of it is the central banks and the authorities' actions and where they are inclined towards. More recently, when we had Credit Suisse problems, we had Silicon Valley bank problems, again, this was not allowed to spiral into a banking crisis. Now, overall, it would seem that the Federal Reserve in particular prefers that they will risk inflation rather than recession. This is because the Federal Reserve has it's a dual mandate. They both want to prevent growth downwards, especially unemployment increasing. At the same time, they want to control inflation. It's not an easy balance for the central bank, but this overall has benefited asset owners. They've come under quite a lot of criticism, and of course, missteps are still totally possible. But this is one element that gives me comfort as to why I think if we can stay invested, that we might be able to right through the recovery with more confidence. In fact, in the bear markets I've shown you, I think out of 16 bear markets, in 9 of those, the investors were able to recover within about a year to make back all the return that was lost on paper. To some extent, is there an alternative to doing so? Can we do better? Can we choose better? Can we time better? Now, human beings, we like certainty, so that's why we look for forecasts, even though forecasts have always turned out to be a little bit useless, right? We still seek those. So remember, we talked a lot about exceptionalism, talked about Magnificent Seven not so long ago, and yet if you look at the chart on the left, I'll just point out what the most bottom and the most top ones are. This is a year-to-date return of just the index of the S&P 500 is the bottom one. So this is a very different picture depending on the time frame that you look at. And whenever you look at returns, you have to look at different time frames because one time frame doesn't tell the whole picture. But this is the year-to-date returns, which is a total reversal of what it was in the last few years. Of course, the question is, will it continue? We do not know. The top line is actually the developed world minus, world minus the US. And the one just touching sort of in orange is actually the Straits Times Index. Now, please take a leaf out of the US market book. Past performance really, as we always say in disclaimers, is not an indicator of future performance, and recent performance really cannot be used to pick sectors and stocks. So please don't go out and now, okay, I'm going to buy more and more Straits Times Index, right? That's not the consideration. It's not what it has been, because we do see a lot of news saying that, okay, maybe we should just buy Singapore. Remember, Singapore is not immune to what happens in the global markets. To some extent, we are a price taker in many economic matters. So the right chart shows the benefits of diversification. We always think about diversification in terms of reducing your risk, right? In terms of, okay, something happens in one side I'm protected because I'm not buying all the losers. That's part of it, but you're also always buying the winners. Right? So whenever you're diversified, you always have a little bit of the winners as well. The chart there shows you that if you don't diversify and you try to pick, if you miss out the top 10 or you miss out top 25, actually your annualized returns go down a lot. So this is a compound annual return over 14 years. So you can do the math, and that this 3% or 4-5% is actually very significant for your portfolio. This shows about timing. So the just now was about selection. This is about timing. Now we always think that we can move in and out, and that's better. And it's actually called de-risking. In fact, that's one thing that is the markets or professionals like to say, de-risking. But you might actually be risking your portfolio more, your retirement more, your children's education more so when you react than when you don't react. And this is sort of a similar picture to what I showed you just now, but it's over a very long horizon of let's see, 30 plus years. That just missing a few days in those 30 plus years can reduce your nest egg by quite a bit. So that's why I say that, from a strategy perspective as well, why we say stay put. We say stay put not only because you can gain it upside, but because if you don't stay put, you actually incur quite a bit of downside. So on this whole matter of being an investor, stay put. Right? Tariffs war will make markets very volatile. I can almost bet that I don't forecast many things, but I can almost bet that volatility will be there in the next few days. It's not going to be one way down or one way up. The impact on earnings in particular, as I've shown you, or in earnings estimates being downgraded, mean that it will get worse before it gets better. Now, we all want to avoid the down days. The unfortunate thing is I cannot tell when the down days are, but I know that there will be up days. So do you want to, when you cannot avoid the down days, but you can avoid missing the up days, may we suggest to you that remember the evidence, the history, the logic of markets, and stay put. And then keep investing. You have a plan to invest every month. Keep doing that. Now, I just want to say that this is not about buying dips. Buying dips, and Bill Gross has come out to say that if you stay in the markets, you buy dips, you're going to catch a falling knife, which just means that it's going to go down. Buying dips is usually for traders, buy dip, then go up. So this is about when you invest in potentially a bear market, it's about riding through, right? So please don't put your retirement funds at risk. Don't put your goals at risk. I say that you are not a fund manager because fund managers, my colleagues in fund management, they have a tough time. They have to report monthly returns, quarterly returns, 3-year returns. And then they have to think about how, they can move in and out, what they can select and all that. And when you look at news, these are all the people talking, but they're actually talking to their goals, right? And whereas your goals are very different. Your goals are your life goals. So you don't have to do this. If you have the time horizon, you don't have to participate in all the fear that a once in a century event creates. Okay, what about beyond investing? Is it just about investing? Are there things that we talked about? Now, of course, DPM Gan has said there'll be a significant impact. And in Singapore, we are open economy. Trade is 3 times our GDP. The news is not good here, or rather the prospect is not good. We really have to brace, just like the US consumer, for potentially higher prices. The CPI index here, we see that last year, the CPI was 2.4%. It's come down from quite a bit. Will it go up again? This is the question. But for now, it is comfortable, and we are anticipating that it could be even lower than that for what has been the beginning of this year, because it's a year-on-year issue. There might be dimmer job and wage prospects. This is the same dynamic that when companies are unsure, when their costs go up because of tariffs on goods, and when demand, it can have that vicious cycle, and possibly both. So we need to brace for it. The stress here is on what we call the left side of your personal wealth equation, your personal money equation. Just now I talked a lot about the right side. Sometimes people think that because the stock markets are very noisy, they're very loud, they come onto the media, that when things like tariffs happen, you're trying to do a lot of things on the right side, which is about investing. But actually, you don't have to mess with it because you have the time horizon, you just stay put, and you can't control it anyway. So it is futile exercise to try to control it on the right side, but you have to control it on the left side. How can you control? It's mainly in terms of your income, expenses, and including your loan payments. What can you do with these things? Well, for income, it's about safeguarding your income, and that's nothing to do with markets, but it's all to do with how you as an employee are working, how you keep up to date, and how you contribute and add value. or as a business. So then you have to control your expenses. Now it's very boring, but it's very important. Cut down on your expenses, increase your savings, right? This is your buffer, this is your muscle, this is your cushion, right? Having certain, these are ratios that we propose. On the debt servicing ratio, I want to point out that we are at 35%. When you go to the bank and you try to borrow, they say 55%. We are more conservative. Why? Precisely because of situations like this, because you might be stressed in various ways. So please also don't commit to expensive, complex investments that tie you in which you pay a penalty if you don't pay that premium or that. Don't look to investing out of your way of the impact of, say, losing your job. It is down to the boring stuff of saving or being careful with leverage. Yeah. So please take note of this, especially non-mortgage debt. Mortgage debt, fine. I think most of the time we treat it as good debt. What you do need to look at is that create that buffer, including in your CPF ordinary account, to pay the monthly installment in case something happens to your job or your income. But non-mortgage debt, cut down on those and do it now. The comfort here, again, like in the US, but possibly more so than in Singapore, is that our policymakers have room. The volatility in the currency market yesterday that we saw was actually quite contained. If you look at the US dollar versus Sing dollar, and this is of course not by accident, central banks do take a lot of effort to do this. What the economists are saying is that even as exports are stressed because of tariffs, there is a possibility to ease monetary policy. In Singapore, it's not an interest rate policy, it's actually an exchange rate policy, such that our exports can still be okay. Yeah, because inflation has eased, so there is some room there. Now, at the same time, if inflation goes up, I think DPM Gan has already said that the government will continue to support households and support individuals and families, workers, if there are any stagflationary pressures, meaning that if we have that poor combination of increasing prices as well as decreasing growth and employment prospects. So maybe to sum up, sometimes there are things that happen we can't control. So there's this famous paradox called the Stockdale paradox. You can look it up. It's from a Vietnam War hero called Admiral Jim Stockdale. We have to confront the brutal facts. I don't want to tell you that everything is going to be okay actually because of this and that. There will be more volatility ahead, but we can keep the faith. The volatility ahead is on the economic side, it's the geopolitical side, and it's on the market side. But the main concern is actually with the economy, and therefore with our short-term financial management. And how many years? Well, maybe next few years ahead. And that is, next few years is very different from 30 years, 15 years, 10 years. And that's why on the investment side, you don't have to mess with that. You can, if you are still in the long term, you're taking a long-term view and you're disciplined, you can only stand to gain. Stick to the plan to dollar cost average, stick to the plan to gain above inflation returns. Focus on what you can control rather than trying to guess what it might be. So tighten your belts through old-fashioned financial discipline. And so how do we deal with once in a century events? You use the evergreen throughout centuries principles of investing and of course of personal financial management to tide us through. So thank you now really for watching, and now we have I think some questions that my colleagues would have.
Thanks, Trenton, for the presentation. I think I do have a few questions for you, and you might have alluded to this in your earlier presentation. But with the financial market seeing such a big loss overnight, and you yourself said that things will probably get worse before they get better, and that among our investors there must be a lot of temptation to just withdraw all the investment first, store it aside where it's safe, and then wait for all this to ride out until things are more settled before thinking about coming back in. Do you think we should do this? What is the harm of doing that?
Yeah. So, MoneyOwl, we don't do any direct selling. So when we look at things, we look at what is good for us as investors and in our financial plans. And yes, I think that it's quite easy to sell. It's quite easy to say, okay, things are not looking so good. And I'm quite sure that there'll be 101 reasons why we should sell. I've given you a few. Economic situation is not good. The earnings situation in particular seems that we are talking about downgrades, and the valuation seems a bit high. But I think that we need to understand that when it comes to investing success, self-management is actually key. It's not actually what's happening in the markets. Imagine that you sell today. What are you going to do? When are you going to get back in? If we ask ourselves, actually, we don't know. We need a plan to say that, okay, we know that there'll be wonderful opportunities, but it is so easy to with. And even professionals don't get this right. So I always tell this story. I was in fund management maybe about 10, 15 years ago. 15 years ago already, during the financial crisis. And we always wait for the data to turn, and I had colleagues who lost investors quite a bit of money, and also in the end put their own careers on the line because they were still waiting for the turn in the markets. Markets are the leading indicator. They will always turn in advance of the actual economic data turning, and so you can't really tell that in advance when that turn would happen. So rather than say you sell now and then you actually will be so scared to get back in, why don't you just ride through the thing? I think that's a better strategy overall.
Yeah, thanks for that. Some people say you should never waste a good crisis, right? So, and I think we are safe to say we're in some sort of crisis right now, some might say. But what about picking stocks, right? Maybe this might be a good time where some stocks perform better than others. I hear that tobacco and household items are doing well because people always need to smoke and go to the bathroom. What do you think about that? For that matter, should we switch over to bonds?
Yeah. So yeah, yesterday we had quite a number of people on CNBC and others saying that they will buy TLT. TLT is the long term bonds, and of course, I think McDonald's went up, British American Tobacco went up. I think two things. One, the speed at which these things happen is very fast. Again, you might buy something and then let's say the Trump administration announces some compromise, then what will happen, right? So that's one thing. But I think the other thing really is that you can't tell when the rotation would happen. There's so many things that cause a stock to go up or down. And what I said that the stock market always recovers and goes up in the long run is it only applies to the whole stock market, diversified stock market. It doesn't apply to individual stocks. Yeah, some of these can really tank and that. I think what we recommend is this. I have spoken before about like a kind of 80-20 rule. Keep your core portfolio, whatever you want to do for your long term, just keep it. But if you have additional funds and you feel like doing this, then treat it as that side hobby if you want. If it happens, then good. If it doesn't happen, at least you still have your core portfolio intact. I think it's too much to bang your goals on a few stocks because you might get in wrong. I guess that's the recommendation that I have. So if you're comfortable with staying invested for your core goals and you know that you can take a little bit of risk, but a little bit of maybe 10% or 20%, yeah, I think then let's try it out there rather than risk everything.
Yeah, I think I'll hold off investing in cigars and toilet paper for the time being, right? So, for this year, we've been following the Fed news. There are some expectations of interest rate cuts this year. In fact, I was quite sad to hear last week that banks like UOB and OCBC have started cutting interest rates on their savings accounts. With all this volatility and turmoil that's going on, what do you think will actually happen to interest rates this year?
So we had quite a bit of lament going on in the social media circles that said, oh, OCBC 360 down, UOB down. On the other hand, I had some friends who just refinanced their mortgages and they were a little bit happier that it was not like kind of 3%. It was more. When it comes to interest rates, I think it is going to be very hard because in Singapore, we generally have follow global interest rates, right? So the Fed will be in a difficult position because on one hand, they have to watch for the inflationary impact of tariffs. On the other hand, there is that huge risk to growth. Right now, inflation is not so high in the US, and neither is unemployment. But the unemployment, there's some news that from the let's say Atlanta Fed and all that, there are some indicators that employment might come under stress. The employment figures are not leading indicator; they are actually a more coincident. That means indicator. It's just the data that. I think that the overall is therefore uncertain. If I were forced to make a forecast, I would say that they're probably not going to risk a crashing economy with if tariffs are causing economic growth uncertainty. So for us in Singapore, I think that the main thing to do is to look at your funds. Don't chase just yield, because when people chase yield, that means like interest rate ties, they will have to go down the credit curve. What I mean is that they'll start to take more credit risk and all that. And that's not something you can afford in this kind of economic environment, because companies might go belly up if they cannot refinance and all that. So I think interest rates, there'll be this balance. I would say that this probably won't be going up any time soon, if I had to take a guess. Whether or not come down, I'm not sure. So we just have to accept where it is. We've seen where the 10-year bond is for Singapore. It's for 2.4, it might drop further. So we have to keep, if it's cash, that's me, keep cash in cash, but also look out for opportunities for growing longer term your assets, including in the markets or in a suitable portfolio for you.
Well, thanks, Trenton. I think for the information and also the good advice. I think that's all that we have for today. If you have any more questions that you would like to ask, please leave them in the comment section and we'll come back to you. Thanks for listening, and don't forget to follow us for more videos like this. Bye-bye.